This is the second lecture in capital structure. We will be continuing our discussion in Modigliani and Miller theory. So, what we understand is Modigliani and Miller say that the capital structure is not going to be relevant to the value of the firm. So different capital structures could still give us the same firm value, and if two firms are otherwise similar but for differences in capital structure, we can't expect them to have different value. So that's exactly what Modigliani and Miller tell in their theory with respect to capital structure. Now, if that is not going to be seen, let's say there is a difference between two firms which are identical but for capital structure, then they say that that difference is absolutely temporary and is something that can be is something that would vanish if an activity called arbitrage is done. So we spoke about two types of firms in the previous lecture. We spoke about a levered firm and an unlevered firm. And if the levered firm and the unlevered firm were identical but for the differences in capital structure, then the value of the levered firm has to be equivalent to the value of the unlevered firm. If that's not going to be the case, then we are going to be doing an arbitrage. And when we talk about arbitrage, there are two types of arbitrage we saw. One was primary arbitrage and the other was secondary arbitrage. Primary arbitrage is done when the value of the levered firm is higher than the value of the unlevered firm. And secondary arbitrage will be done when the value of the unlevered firm is higher than the value of the levered firm. So now we are going to be looking at question number 2. We are going to take this opportunity to understand how a primary arbitrage has to be done, and we are also going to be understanding all the steps in the process and the logic behind each and every step. So as I said in the previous lecture, you'll need to closely look at what's happening and understand question number 2 in its entirety, and then question number 3 is going to be something that you'll have to try on your own. And all you need to do, as I said in the previous lecture again, is to replicate the steps that you would learn in question number 2. So let's take a look at question number 2 right now. You have two companies, L Limited and U Limited. There is a table that gives us some information, but beneath that we have a paragraph. Let's first read that. If L Limited and U Limited are into the same business, have similar operations, and are into the same business risk class, but differ only in terms of their respective capital structure, how can an arbitrage be done? You may assume an investor holds 10% shares in L Limited. So by reading this, what we understand is L Limited and U Limited are two companies which are identical, and they are in the same business, they have similar operations, they face the same business risk. The only difference between L Limited and U Limited is they have different capital structures. So now we are supposed to look at how an arbitrage can be done. And for that, we are told an investor holds 10% shares in L Limited. Now, first of all, an arbitrage needs to be done only if the value of L Limited is not equivalent to the value of U Limited. Only then we will do an arbitrage. If the values if the value of L Limited is the same as the value of U Limited, then there is no need for us to do any arbitrage. So let's first find out if an arbitrage has to be done. That's always probably the first step to confirm that an arbitrage is stupid. So even when a question asks you to perform an arbitrage, it's very important that you confirm for yourself that an arbitrage actually has to happen. And for that, what is that you will have to see? You should look at the value of the levered firm and the value of the unlevered firm and satisfy yourself that these two values are not the same. Now, let me draw your attention to the value of L Limited. So here, the value of L Limited is 52 lakhs 50,000 is 52 lakhs 50,000, and the value of U Limited here is 50 lakhs. So you have 52 lakhs 50,000 as the value of L Limited, and you have 50 lakhs as the value of U Limited. Now, which of the two is a levered firm? I'm going to say L Limited is the levered firm because if you observe closely, you have a certain value for debt in L Limited, but the value of debt in U Limited is nil. That means what this actually means is U Limited does not have any debt, but you're given a certain value for debt in L Limited. So that's 30 lakhs to be precise. So this means L Limited is a levered company and U Limited is an unlevered company. And here we know that L and U are identical, but for differences in capital structure. Ideally, we should have had value of L limited this be equivalent to the value of U limited, but we don't see that. We see 52 lakh 50,000 here for L limited, and we see 50 lakhs for U limited. So the value is not the same. So that confirms that there is a need for an arbitrage. But what arbitrage should we do? Should we do a primary arbitrage or should we do a secondary arbitrage? Well, which firm is greater in value is what would decide if we should do a primary arbitrage or a secondary arbitrage. Here we see value of a levered firm higher in value. So we understand that a primary arbitrage has to be done. So once we have decided that, then let's start looking at what are the steps involved in the arbitrage. So typically you can always expect the question to tell you what is the stake of an investor in the overvalued firm, because as we saw in the previous lecture, what an arbitrage actually wants us to do is sell stake in an overvalued firm and buy stake in an undervalued firm. So for that, typically any question that wants you to do an arbitrage would give you the stake in the firm with higher value. So here, since we have the levered firm having a higher value, the question tells us that you may assume an investor holds 10% shares in L Limited. So if an investor holds 10% stake in L Limited, L Limited's equity, so how is this investor going to do an arbitrage? So we are basically going to step into the shoes of the investor and do this arbitrage, but let's first note down the stake that he has. Investors stake in L Limited is equivalent to 10%. So he has a stake of 10% in L Limited. So now let's see how he is going to carry on the arbitrage. The first step that he will carry out is sell stake in L Limited. So he has a certain stake in L Limited. He is going to sell that stake in L Limited. So what is the amount he is going to obtain by selling the stake in L Limited? Amount obtained is going to be 2,25,000. Now, the calculation of 2,25,000 goes like this. 22,50,000 is the value of the entire equity of L Limited. So we know our investor has 10% stake. So he basically owns 10% of the equity of L Limited. So if he's going to sell that, obviously 22,50,000 into 10% is would have been the value of his holding. So now he sells that. So amount obtained in cash. So he now has cash of 2,25,000 with him after he sells his stake. So right now we have cash available after sale. Okay. So let's kind of visualize a balance sheet for this investor. So before he sold the stake of 10%, the investor's personal balance sheet would have looked like this. Okay, so let's have a simple balance sheet. This is investor's balance sheet. We are not talking about L Limited or U Limited's balance sheet, investor's balance sheet. So in the investor's balance sheet, before the investor sold his stake, he would have probably had an asset here, and that asset would have been called investment in L Limited shares, and he would have that asset would have been carried at a value of 2,25,000. So before he sold his stake, his balance sheet would have had an asset at 2,25,000, and that would have been called investment in L Limited equity. And On the liability side of the investor's balance sheet, you would expect to see equity of 2,25,000. So what does equity mean? Equity talks about the owner of the entity you're talking about. So here, the investor is the owner when you talk about the investor as the entity also. So what this actually means is the investor has an asset of 2,25,000 and that asset was made possible by his own money. So we are not told that the investor has borrowed money somewhere and has invested 2,25,000 in the equity of L Limited. So what we assume is the asset of the investor, which is the investment in L Limited, is made possible through his own money. So we say on the liability side of the investor's balance sheet, we have an equity of 2,25,000. So this would have been a simple balance sheet of the investor before the stake of 10% was sold. Now, after the stake of 10% is sold, still the balance sheet would carry an asset at 2,25,000. The only difference is the asset is no longer going to be called as investment in L Limited. The asset will now be called as cash because the investor has liquidated his stake of 10%. So after his sale of 10%, he still has an asset. But the value of the asset is still 2,25,000. But the name of the asset changes, the nature changes. It's no longer an equity investment, which is the asset, it is cash. However, on the liability side, you do not expect any change at all because that 2,25,000 is belongs to whom? It belongs to the investor, right? So there is no change happening on the liability side. So after this sale of the stake, you expect the asset side alone to change just to this small extent here. So now once we understand that, let's look at the second step. So what does the investor do? Before we go to the second step, let's try to visualize what the investor could potentially do. Now that he has 2,25,000 rupees with him, what do you think he will do? Now we said you are going to when you do an arbitrage, you're going to sell stake in the company which is overvalued, and you're going to buy stake in the company which is undervalued. So what actually happens here is the investor is likely to use this money to invest in U Limited. So he exits from L Limited and he's now likely to go and invest his money in U Limited. So that's what we think that the investor is likely to do. Well, that's exactly what he is going to do. But before he goes to U Limited for investment, he's going to do one extra thing here. Now, what is he going to do? He is going to borrow some money. He is going to borrow money for investment. So he definitely invests money in U Limited, but he is not going to invest just 2,25,000. He is going to invest rupees. He is going to invest an amount which is going to be higher than 2,25,000 because he's not going to invest just the 2,25,000 which he was holding in L Limited. He is actually going to go and borrow some money, and then he's going to put both of these things together and then invest it in U Limited. So he's going to invest 2,25,000. He's also going to invest something extra. Now, why should the investor borrow some money and then invest in U Limited? Why can't he directly go and invest 2,25,000 in U Limited? Well, I'm not going to tell you the reason for that right now. I'm going to carry out the arbitrage. We're going to come to a logical point where it will be worth discussing why the second step is important. And in fact, the way the borrowing is going to happen is also something that would be explained, but not now. So let's take the discussion to a logical point when we can again come back and try to understand what's happening here. So it's essential to understand that the investor will not directly invest 2,25,000. He's going to borrow, but the logic behind it is something that we can see. Now, when we say borrow, the next question is how much will he borrow? And at what rate is he going to borrow? That's going to be the next important point. So let's address both of these things here. The investor will borrow 3 lakhs. The investor is going to borrow rupees 3 lakhs here, and he is going to borrow it at cost of 10%. So the investor is going to borrow 3 lakhs at a cost of 10%, which means on his borrowing, he has to pay an interest of 10%. So the interest he would pay annually for his borrowing of 3 lakhs is going to be 30,000 rupees. We know that. So he's going to borrow 3 lakhs. And now after his borrowing, immediately after his borrowing, if you see, let me draw the investor's balance sheet immediately after borrowing. Um, the investor now will have cash of not 2,25,000. He's going to have cash of 5,25,000. But now the liabilities side, the investor has equity of 2,25,000, and the investor now has debt of 3 lakhs because he has borrowed 3 lakhs of money. So to get both of these things put together will total up to 5,25,000, which is the only asset. Now remember, we are not talking about the company's balance sheet, we are talking about the investor's balance sheet. So here when I say debt, I'm talking about the borrowing of the investor. I'm not talking about the borrowing of any company here. Similarly, when I say equity, I'm talking about the owner's money from the perspective of the investor, and here the investor is the owner of 2,25,000 here. So that's to be understood. And similarly, the cash of 5,25,000 is an asset from the investor's perspective. Okay, so we are drawing the investor's personal balance sheet. So as soon as the money is borrowed, this is how the balance sheet will look like. Now what we're going to do is we look at step number 3 here. Let's look at what step number 3 is. Invest in U Limited. So now how much of money is going to be invested in U Limited? Rupees 5,25,000. So 5,25,000 is to be invested. Now, what we understand from this step number 3 is 5,25,000 is getting invested in U Limited. Part of this money comes from the sale of stake in L Limited, which is 2,25,000, and part of this is from the borrowing which was done. So step number 2 was borrowing, so that gave us 3 lakhs, and the sale of stake in L Limited gave us 2,25,000. Both of these put together, we get 5,25,000, which we invest in U Limited. Now let's talk about step number 4. We're going to call step number 4 as net earnings in U Limited. All right. So first thing I'm going to do is I'm going to calculate what I call as gross earnings. First point to be very clear about is when we say invest in U Limited, invest in what? U Limited is a completely unlevered company, which would mean U Limited has no debt finance. So the only avenue available for an investor in U Limited is equity. So as an investor, if I go to a company, I have two choices. I can either invest in the shares of the company, or I can invest in the bonds or debentures of the company, provided all of these are an issue. If the company has only equity, then I can invest only in the equity of that company. So here when I say invest, I talk about equity investment. So now what I will do here is I will draft the balance sheet of the investor once again. Investor's balance sheet. All right. Cool. So on the asset side, we are going to have something called investment in equity of U Limited. This is going to be 5,25,000. And on the liabilities side, we are going to have equity, which is 2,25,000, and we are going to have debt, which is 3 lakhs. So essentially what this means is, now the investor, let's compare this balance sheet with the previous balance sheet. As soon as the amount was borrowed, but before the investment was done, the investor has an asset called cash, and that was for 5,25,000 in value, and that amount, that asset of cash was funded through two liabilities: debt of 3 lakhs and investors own money of 2,25,000. Now when you look at this balance sheet here, the asset called cash is converted into investment in equity of you. So now the asset value still remains to be 5,25,000, but the nature of the asset changes. So no longer is it cash, it is basically investment in equity of you limited. But the liability side, nothing is going to change, because what made this investment possible? Investors own money of 2,25,000 and borrowed money of 3 lakhs. So it's very important to understand the equity here and the equity here are two different things. The equity on the asset side here that you see is basically saying that the investor is investing in the equity shares of you limited. So that's the significance of the equity appearing on the asset side. This equity that appears here is referring to the investor's own money that gets invested in the asset there. So you should very clearly understand the significance of equity appearing in both places. Now that the investor has invested 5,25,000 in the equity of you limited, let's see what is going to be the gross earnings that the investor is eligible to get. You limited is a company which has 7,50,000 rupees of earnings for the entire equity. This is something that I'm picking from the question. The question tells me earnings to equity is 7,50,000 for you limited. Now, who can share this? All the equity shareholders can share this. The total value of equity is 50 lakhs. So for every 1 rupee of equity, what is the earnings available? This is the earnings. So 7,50,000 is available for entire equity. For every 1 rupee of equity investment in you limited, what is the earnings? 7,50,000 divided by 50 lakhs. This is like saying, for example, there are the earnings is 10,000 for all the shares. There are 1,000 shares. So what does each share get? Now we are obviously going to say each share is going to get 10 rupees, right? So exactly on similar lines, now we are saying the earnings that you limited has made for the entire equity is 7,50,000. For 1 rupee of equity investment in you limited, the earnings is 7,50,000 divided by 50 lakhs. Now how much has this investor invested? The investor has invested 5,25,000. So the investment in you limited equity shares is to the extent of 5,25,000. So this is going to be the gross earnings. Let's calculate that. 7,50,000 divided by 50 lakhs into 5,25,000. So the investor is now able to take home 78,750. So this is the gross earnings. Now, can the investor keep the entire amount of 78,750 with itself? Definitely no, because we know that the investor has borrowed 3 lakhs of money on which interest of 10% has to be paid. So let's capture that also. Interest to be paid on debt is going to be 3 lakhs into 10%, which is going to be rupees 30,000. This is something that we already saw earlier. Now let's look at the net earnings that the investor is eligible to get. That's going to be 78,750 minus 30,000, which is going to give us 48,750. Great. So we have net earnings of 48,750. Now the question is, so what? So what have we achieved here, and how is this arbitrage? How can I say that this arbitrage is of value to the investor? What is it for the investor to have done this arbitrage? Because I mean, the reason I'm asking this question is when I looked at arbitrage, I said basically in an arbitrage there are two things. One is I mean, what is an arbitrage? A mispricing or a misvaluation is exploited, and two things happen in that. One is the person exploiting it tries to make a gain for itself, and in the process, the mispricing or misvaluation also over a period of time should vanish. So now the investor has exploited this misvaluation and has tried to exploit it by carrying out this arbitrage exercise. What is in it for the investor? How do you think the investor has gained? Now it's very simple. Let's try to draw a comparison here. What was the investor's position in L Limited? What was the investor's position in U Limited? So let's draw up a simple comparison. This comparison will help us in understanding how this arbitrage was in fact useful for the investor. Now L Limited and U Limited. Let's talk about net earnings. Now, U Limited, U Limited, we already know the net earnings is 48,750. L Limited, let's see what is the net earnings. Let's calculate that. If the investor had remained with L Limited would have earned 4,50,000 for all its shareholders, and L Limited has an equity value of 22,50,000. So this will tell us what is the earnings for 1 rupee of equity investment, and we know that our investor had 2,25,000 of earnings. So from this, what we can understand is, let me put that here. So since the investor has 10% stake, the earnings the investor is eligible for is 45,000. Now, net earnings that the investor was getting in L Limited is 45,000, and the net earnings the investor is getting in U Limited is 48,750. What was the investment? Let's see, look at the investor's investment. Now you'll understand the significance of why I am saying investor's investment. As long as the investor was with L Limited, we can say the investment was 2,25,000. Now in U Limited, what was the investment? Well, it looks like 5,25,000 is the investment, but I'm going to write here 2,25,000 only. The reason is I have said investor's investment. So how much of the investor's money is going inside U Limited? We know it's only 2,25,000 because only 2,25,000 of the investor's money is going inside. Now, what about the balance 3 lakhs? It is not the investor's money, it is somebody else's money because it's a debt. It's borrowed finance. So, investor has invested only 2,25,000 in U Limited, and for investing 2,25,000, after paying interest to the person from whom debt was raised, net earnings that the investor is making is 48,750. Understand that 45,000 and 48,750 are comparable because 45,000 is also net earnings available to investor. 48,750 is also net earnings available to investor because 48,750 is after subtracting the. If we had put 78,750 here, then we are doing a mistake. But we appropriately subtracted the 30,000 of interest and we are capturing only 48,750 here, which means 48,750 is for 2,25,000 of investment. 45,000 is also for 2,25,000 of investment. So what we understand is for the same investment of 2,25,000, look at it this way. The investor has 2,25,000. If he had kept the money with L Limited, then he would be eligible for net earnings only of 45,000. But the same investor, he takes his 2,25,000 out of L Limited and keeps it with U Limited. He is going to get a net earnings of 48,750. If I was the investor, I would definitely do this. Any rational investor would do this, mainly because for the same investment, obviously, why should I leave an avenue which gives me a higher return, right? So I'm going to invest 50,000 in bank 1 that gives me 10%. Now bank 2 comes and tells me I'm going to give you 12% return. Obviously I'm more likely to go to bank 2, right? So on exactly similar lines here, if my investment value is going to be the same, I'm obviously going to go for to an avenue which offers me a higher return. Now, so what we understand here is an investor is, and no, what we understand here is we can put it this way: the possibility of getting the extra of I would say 3,750 would attract every investor having 10% stake in L Limited to move out of L Limited and go to U Limited. So as more stake is sold in L Limited, over a period of time we can expect L Limited value to reduce, and as more stake is purchased in U Limited, we can expect the value of U Limited to increase, and over a period of time we can expect L Limited value to be equivalent to U Limited value. So that's something, again, as I said, we do not know when this will happen. As soon as one investor does this, uh, definitely we can't expect L Limited value to immediately magically become equivalent to U Limited value. We do not know that. But over a period of time, definitely we have reasons to believe that L Limited value should reduce and U Limited value should increase. So that's the entire idea behind this arbitrage. So for the same investment, the investor is able to get a higher net earning. So that's what is the advantage for the investor which is doing this arbitrage exercise. Now, there are some questions here that you might have which are unanswered at the moment. So this is the comparison is something that you can understand, and you can see how the arbitrage has given value to the investor. That's something that you've understood, and you would have also probably understood how you can expect over a period of time the values of the two companies to come to an equilibrium and be equal to each other. So these two things I'm sure you would have you would have understood, but there are obviously some questions in your mind which we definitely need to now look into. This is the time where we'll have to question a few things that we have done here. Now, why did we borrow money, first of all? And that too, why did we borrow 3 lakhs? And why did we borrow at 10%? So all of these things, if we actually seek an answer to step 2, if we seek an answer to the questions, unanswered questions that we have with respect to step 2, then this entire arbitrage exercise will make a lot more sense to us. Let's get an answer here. Now, one very important thing we should understand is the reason that the investor is able to get a higher earnings of 48,750 is basically because the first observation I'm going to make here is, see, we do understand that out of the 5,25,000 which gets invested in U Limited, definitely one component is this 3 lakhs here. Now let's see what happens. 7,50,000 by 50 lakhs, this basically gives us a return of 15%. So U Limited is giving its equity investors a return of 15% on equity investment. So if I invest my money in U Limited's equity, I can expect to get 15%. So now this investor is investing 5,25,000 in the equity of U Limited. Now let's focus on one component of this 5,25,000, which is 3 lakhs. Now, this 3 lakhs of finance, which the investor is investing in the equity of U Limited, we understand that the cost of that finance for the investor was 10%. So, as an investor, now one thing is for sure, my 5,25,000 comprises of 2 parts: my own money and borrowed money. Now, I'm focusing only on the borrowed component here. So, as an investor, in my total investment of 5,25,000, the borrowed component has a cost of 10%. But the borrowed component, when it is invested in U Limited, it has the potential to earn 15% return for me. So what happens here? Look at this. I raise 3 lakhs of money at 10% cost and I invest that at 15%. I make a 5% return in between. So that's the main reason that I'm able to get a higher earnings here. So the main reason I'm able to get a higher earnings here is because I borrow money. So this is a high level answer to the question, why borrow money? Why can't I just invest 2,25,000? This is the reason. I find an opportunity to borrow at 10% and invest at 15%. Definitely that's going to be great, right? So let's try to see what is likely to happen if I don't borrow. Let's say I invest only 2,25,000. Okay, let's say I avoid step number 2. I sell stake in L Limited. I get 2,25,000. Let's say I just invested in U Limited. I don't borrow anything. Then what is the gross earnings I'm likely to get? So if I'm going to just invest 2,25,000, let's see what is the gross earnings I'll get. So we know 7,50,000 is the earnings for all equity, for the entire equity in U Limited, and the entire equity value is 50 lakhs. So for every rupee of equity, this is the earnings. We know this is 15% into 2,25,000. So let's see what this gives us. So 2,25,000 into 15%, we get 33,750. Now this 33,750 also becomes our net earnings, because since we have not borrowed any money, there is no question of subtracting any interest. So the gross earnings automatically also becomes the net earnings. So now we see here, now if I were to draw a similar comparison, I would say for my investment of 2,25,000 in L Limited, I was getting 45,000. So this is not going to change. If I had continued with L Limited, I would have gotten 45,000. Now I have invested in U Limited. I'm going to get only 33,750. So I'm definitely not likely to do this. Why would I for the same investment of 2,25,000? Why would I move from one place to another place just to get a lesser earnings? In the previous case, when I borrowed 3 lakhs and went to U Limited, it made sense because for the same investment of 2,25,000, I was getting extra. I was getting 48,750 as against 45,000. So it made sense for me to move out of L Limited and approach U Limited. But now it doesn't make sense. So if I didn't borrow here, I wouldn't have gotten that extra earnings for the same investment. So not only have we understood the logic that we are borrowing at 10%, cost of 10%, and we are getting a return of 15%, that's contributing. We have also proved it by using numbers here that in fact it is borrowing which is giving us the higher net earnings here. Now the next question that we'll have to answer is, if that's going to be the case, why do I have to restrict my borrowing to 3 lakhs? Why not I borrow 5 lakhs? Let's try that out. Let's assume that we borrow 5 lakhs of money. Okay, we have sold stake of 2,25,000. Now instead of borrowing 3 lakhs, let's say we borrow 5 lakhs. Let us see what is the gross earnings we will get. Okay, this is if we have borrowed 5 lakhs. I'm going to say, obviously this is not going to change, 7,50,000 by 50 lakhs. So this is not going to change here. This is the return that I will get on my investment in U Limited. Now my number here is not 2,25,000. My number here is not 5,25,000. In fact, my number here is 7,25,000. The reason is the 7,25,000. I mean, I can split the 7,25,000 into 2,25,000 of my own money and 5 lakhs of borrowed money. Now let's see what I get. 7,25,000 into 15%. My gross earnings is 1,08,750. Now if I subtract interest, how much of interest should I subtract? I'm going to subtract 50,000 because 5 lakhs into 10%. Let's say I borrow at 10% itself. 1,08,750 minus 50,000 of interest on my borrowing of 5 lakhs. Now let's see what I get. I get 58,750. Well, now here also, if I draw a comparison, I'm better off moving from L Limited and going to U Limited. If I'd stayed with L Limited, what would have been my investment? 2,25,000. What would have been my net earnings? 45,000. If I go to U Limited, what is my investment? Again only 2,25,000 because the 5 lakhs is still borrowed money. The logic why we didn't include the borrowed money here in the when we solve the question is the same logic I will apply here also. Now also I'm going to say my investment is only 2,25,000, but my earnings, net earnings is 58,750. So in fact it looks like borrowing 5 lakhs is much better than borrowing 3 lakhs. First of all, not borrowing and just investing 2,25,000 is not at all good. It's going to dilute my earnings. That's something I wouldn't do. Borrowing 3 lakhs is great. It gives me higher net earnings for the same investment. Borrowing 5 lakhs is even better because it gives me even higher net earnings for the same investment. Well, guess what? If I borrowed 10 lakhs, it would give me even higher. If I borrowed 20 lakhs, it would give me even higher. The higher I borrow, the higher the net earnings I'm going to get here, because any rupee that I borrow, I'm borrowing at 10% cost and 15% return. So it's always going to be good for me. So if I borrow 1 rupee, then I'm going to make a net return of 5% on that. If I borrow 2 rupees, I'm going to make still a net return of 5% on 2 rupees. So the higher the amount I borrow, the better it is in this scenario here, because I'm borrowing at 10% and I'm investing at 15%. If that is the case, then why are we restricting our borrowing just to 3 lakhs? Why don't we borrow 5 lakhs or 7 lakhs or 9 lakhs for that matter? Now the idea is, a very important aspect in arbitrage, about which I also made a passing reference in the previous lecture. Let me tell you when I made this reference. You should recollect that I told you arbitrage is not as simple as I explained it to be, especially when I gave you that one share trading in NSE and BSE at different prices. That example, I told you arbitrage is not as simple as I explained it to be. It's in fact more than that. At that time, if you're able to recollect, I would have made a passing reference saying that you should ensure that there is no risk in doing arbitrage. Now, what this means is, if you get higher earnings by assuming higher risk, then there is nothing great in what you have done, because it's a fundamentally known thing that higher the risk, higher the return. So you take a certain amount of risk and you get some earnings. Now I get higher earnings because I've taken higher risk. Now, well, I mean, I'm bound to get higher earnings because I've taken higher risk. There's nothing that I can feel very happy about. But what's very peculiar to note is, if I've taken the same risk as you have taken and still I end up getting higher return, then that's only when it's probably something that's that is worth even talking about. Not when I take higher risk and take higher return. Now it's like saying, for example, well, you studied for 6 hours every day and you scored a 60 in the exam. Now I studied for 10 hours every day and I scored a 70 in the exam. If I come and tell you I scored 10 marks more than you, what are you going to tell me? Well, you're bound to score 10 marks more than me. In fact, you should have scored much higher, because when I studied for 6 hours, you studied for 10 hours. You studied for 4 hours extra. So what's the big deal? If I had studied, I would have also gotten 70. But if you studied for 6 hours a day and I also studied for 6 hours a day, but both you get 60 and I get 80, that's when it's even worth discussing. So what did I do that got me 20 marks extra when you and I studied for the same number of hours every day, right? So it's exactly like that. So arbitrage is very interesting only if you're able to get higher net earnings for the same investment without taking any additional risk. Now here, if I borrow 3 lakhs, what happens is I have not taken any additional risk, mainly because now let's look at this balance sheet and see what is the personal debt equity ratio of the investor. Personal debt equity ratio, I'm going to say it is 2,25,000 is to 3 lakhs. This is the it's the other way around. It is 3 lakhs is to 2,25,000. Okay, so let me simplify this as 300 is to 225. Okay, I mean, it can be simplified further, but let's have it here. 300 is to 225. So this is my debt. This is the personal debt equity ratio of the investor after he has borrowed 3 lakhs. Now, if the investor remained with L Limited, if the investor did not sell his stake in L Limited, then the investor is still exposed to a debt equity ratio of 300 is to 225, because the company in which the investor has invested has the debt equity ratio of 300 is to 225, because for the company the entire value of debt is 30 lakhs. For the company the entire value of equity is 22 lakh 50,000. So 30 lakhs is to 22 lakh 50,000 is the same as 3 lakhs is to 2,25,000, which is the same as 300 is to 225. So what we see here is, after the investor has exited L Limited, he is maintaining the same debt equity ratio as he was exposed to before he exited from L Limited. So when he was in L Limited also, he was exposed to the debt equity ratio of 300 is to 225. Now after he left L Limited also, he is still exposed to the debt equity ratio of 300 is to 225. So I'm saying that he is maintaining the same risk because he is exposed to the same debt equity ratio, yet he is getting a higher return for the same investment. So same investment, same risk because of exposure to the same debt equity ratio, yet he is getting higher earnings. That's what is making the entire arbitrage very interesting for the investor. Now a very logical question here. I mean, why do you even talk about the same debt equity ratio? How are you concluding that because the investor is exposed to the same debt equity ratio, he is very, I mean, he's not taking extra risk? How do you come to that conclusion? Now, an equity investor, an equity shareholder in an unlevered firm does not have any financial risk. Let's first understand that. An equity investor in an unlevered firm does not have any financial risk. Because an unlevered firm is an all equity firm, and in an all equity firm, there is no question of any person senior to equity shareholders. So there is no question of the company making some earnings and the entire earnings just sufficient to meet the debt and nothing available to equity. There's no such scope for discussion. There's no scope for such discussion at all when you talk about an unlevered company, because there is no debt at all. So an investor, an equity investor, or an investor who was invested in the shares of an unlevered company is not subject to any financial risk at all. But an investor who has invested who has invested in the equity of a levered company is definitely subject to financial risk, because there is some person who is senior to him in terms of with respect to the sharing of earnings. So in a levered firm, there can very well be a scenario where the firm would have made some earnings, but it would just be sufficient to meet debt commitments, and after that there would probably be no earnings available for the equity people to partake. So because of this, definitely there is a risk. Whenever you have a person senior to you and he would first lay his hands on the earnings of the company, then you are definitely subject to risk. So here in our example, is the investor subject to any risk when he stayed invested in L Limited? Yes. What is that risk? Financial risk, because L Limited is a levered company. So what is happening here is the company has borrowed 30 lakhs of money when it has equity of 22 lakh 50,000. So what this actually means is, for every 225 rupees of money that the company has obtained from the equity shareholder, for every 225 rupees that the company has obtained from the equity shareholders, the company has taken 300 rupees of loan. So look at it like this, okay? Just assume the loan taking in this way. The company first raises 225 rupees in the form of equity. Immediately it goes and takes money in the form of debt to the extent of 300. Next 225 rupees, let's say it takes in the form of equity. Then again it goes and borrows 300 rupees in the form of debt. Then again it takes 225 rupees in the form of equity, and then it goes and borrows 300 rupees in the form of debt. Let's say this is what the company does. So for every 225 rupees of money which the company has obtained from the shareholders, 300 rupees of money the company has gone and borrowed. Which would mean, since our investor had 2,25,000 of equity stake in the company, and for the company, out of this entire 2,25,000, this would have definitely be there. So against this 2,25,000, the company would have definitely borrowed 3 lakhs. So for every 225 rupees of shareholders' money in the company has gone and borrowed 300 rupees. So when our investor had invested 2,25,000 in L Limited, against that the company would have gone and borrowed 3 lakhs. So there is, for let's say every shareholder can invest only in multiples of 225. Again an assumption, okay? Every shareholder can invest only in multiples of 225. For every one shareholder, there is a senior guy to the extent of 300 rupees. For every shareholder who has given 225 rupees, there is a guy senior to the extent, and he has a claim of 300 rupees in the company. So now our investor has 2,25,000 equity investment in L Limited. So for him, there is going to be a senior person who will have a claim of 3 lakh rupees, because he would have given the company 3 lakh rupees. So what we understand from this is, when the investor is with L Limited, he is indirectly faced with risk, because for every 225 rupees, company is going and borrowing. So what has happened here is, since he is an investor, he is indirectly exposed to financial risk. So he is indirectly exposed to financial risk. Whenever debt is there, you are exposed to financial risk. Now what happens is, if once he sells 2,25,000 of stake, then if he goes and invests his money in U Limited, he will now have no risk at all. because U Limited is an unlevered firm. If he does not do anything else, he is reducing the risk that he was taking earlier. If he reduces his risk, he can get only lesser return. That is why when we didn't borrow, we got only 33,750. Earlier we got only 33,750. Why? Because we reduced the risk that we were earlier taking. So our return also reduced. But when we maintain the same level of risk, the return alone increase. That is what is the interesting element in the arbitrage. So what's the significance of the 3 lakhs here is that it helps in maintaining the same debt equity ratio that the investor was exposed to earlier. So in a different question, how do I determine the amount I should borrow? Borrow such an amount which would help you maintain the same debt equity ratio as the debt equity ratio of the company in which you are selling the shares. To be even straightforward, I can say borrow such an amount which will ensure that you maintain the same debt equity ratio as the debt equity ratio of the levered company in which you are selling the stake and exiting. It is as simple as that. So that's the logic of 3 lakhs, right? So now why at 10%? Because since the company has borrowed at 10%, the investor was indirectly exposed to 10%. So now he is directly exposed to 10%. So whatever is the rate at which company borrows, that is the rate at which the investor also has to borrow once he exits from the investment there. So this is the idea of why 3 lakhs is borrowed and why 10% is why it is borrowed at 10%. And now you see that if in case the investor borrows 5 lakhs, his debt equity ratio will become 500 is to 225, which is meaning more risk than what he had before. If he takes more risk, then you can expect him to get higher return. But that's not, again, very interesting in arbitrage. We said same risk, same investment, but higher earnings. That's only very interesting. So that is why this step is done the way it is done, right? So this is your primary arbitrage. So to quickly recap what we have learned in primary arbitrage, there is a certain stake you will have in the levered company, sell it off, borrow money, which will help you maintain the same debt equity ratio, borrow at the same rate at which the levered company has borrowed, then put both those things together, then invest the entire thing in the equity of the unlevered company, then calculate your gross earnings, and then calculate what is the amount you should pay to the person who has provided you debt finance, and then see what is the net earnings, and then have a comparison just for yourself to understand if you really got something out of this arbitrage. So that's your primary arbitrage. So now once you have understood this conceptually, from an exam perspective, I would tell you that you just will have to replicate the steps that you have learned here. So sometimes what can happen is you might find a certain source in which an arbitrage question is done probably in a slightly different way. So there is also another way in which an arbitrage can be done. But at this point in time, it's important that we understand what has to be done, and we understand it in the most simplest way possible without looking at several things. So this is definitely an accepted way in which arbitrage can be done. And if you replicate these steps, if at all a question like this comes in the comes in the exam and you replicate these steps, I'm sure you should ideally get complete credit for that. So what I want you to do is, once you understand this from an exam perspective, you should just replicate these steps, okay? In the process of your understanding, I'm sure you would have noted down the most important points. For example, the points relating to step number 2, and then the balance sheets here for your personal understanding. All of these things, once you understand, just replicate all of these steps in any question, and that should help you get complete credit for answering the question. Right? So you don't need to be bothered about you don't need to be bothered if you find an arbitrage done in another way. End of the day, an arbitrage has to be done, and your goal has to be met. Okay, so that's something that I would like to call out at this stage here. And once you've understood all of these steps, as a practice, please look at problem number 3, which is picked from study material, and that should be done in exactly the similar way. And I would definitely suggest practice here. So it doesn't hurt to work this same problem number two, question number two, 3, 4, 5 times, as many number of times as you would want to work it out to obtain complete confidence in performing a primary arbitrage with complete understanding to the extent required. So that is the only way in which you will be able to get a grip of what's exactly happening. So when you listen to the lecture, when you listen to it for the first time, you may definitely want to listen to it for the second time or the third time. So if at all you feel like that, again, there is nothing that you should worry about. So the content here is of that nature. So it's nothing wrong if you feel like listening to it many number of times. Please do that. Listen to it as many number of times as you want and practice it as many number of times you feel you should to get complete confidence. So let's wrap up our primary arbitrage here, and let's get to secondary arbitrage here. So let's take let's take question number 4 here. So question number 4 is going to be an opportunity for us to look at secondary arbitrage. So all right. Now, when do you do secondary arbitrage? When value of a levered firm is lesser than value of an unlevered firm. So basically, when the unlevered firm is higher in value, you do a secondary arbitrage. And you know that we follow the practice of selling stake in the overvalued firm and purchasing stake in the undervalued firm. So that's what we are going to be doing here also. So here, let's take a look at question number 4. Let's see how we have to perform a secondary arbitrage. So we have two companies, J Limited and Y Limited. If J Limited, again, like you had in problem number 4, here also you're given a table with some numbers, but let's come to the paragraph below. If J Limited and Y Limited are into the same business, they have similar operations and are into the same business risk class, but differ only in terms of their respective capital structure, how can an arbitrage be done? You may assume an investor holds 10% shares in J Limited. Okay, so here, like I told you in the previous case when we were discussing primary arbitrage, whenever you get a question which asks you to perform an arbitrage, you must first you must first satisfy yourself that there is a need to perform an arbitrage, and that would mean the establishment of the difference in values between the levered firm and the unlevered firm. So here, let's see which is the levered firm, which is the unlevered firm. So J Limited is the unlevered firm, and here we have U Limited, which is the levered firm, because if you look at the value of debt, you don't see anything for J Limited, so you have a blank there. So that means J Limited has no debt. So that is the unlevered firm, and you see Y Limited, which has a debt of 5 lakhs and equity of 50 lakhs. So U Limited is the levered firm. So let's see which firm has higher value. We know that the question tells us that J and Y, they are in the same business, similar operations, same risk class. All of these things basically tell us that they're identical, but for differences in capital structure. So we know that then U Limited and J Limited must ideally have the same value. Do they have the same value? You don't see same values for both of them, because you can see J Limited have a value of 60 lakhs, but you can see U Limited have a value of 55 lakhs. So you see here that the levered firm is lesser in value compared to the unlevered firm here. So whenever you have a situation like this, the moment you establish this, you understand that you'll have to do a secondary arbitrage here. And as I told you in the previous case, the firm which is overvalued, you'll generally be told that the investor has a certain stake in that. So here J Limited is overvalued, so we have a stake in J Limited. So at a concept level, at a high level, definitely we know we should sell the stake in J Limited and we should invest in U Limited. So let's first do that. Let's look at step number one. So as of now here, let's again start to visualize balance sheets, personal balance sheets. So for an investor which has its money invested in J Limited right now, you can just visualize the personal balance sheet of the investor. On the asset side, you would have investment in J Limited to the extent of 6 lakhs, because it's 10% of 60 lakhs. It'll be 6 lakhs, and then you on the liability side, since the entire 6 lakhs we believe is the investor's own money, you will have equity of 6 lakhs. So on the asset side, investment in J Limited of 6 lakhs, and on the equities, on the liability side, equity of 6 lakhs. So this is how a personal balance sheet for the investor in J Limited would is expected to look like. Now let's go in for step number one, sale of stake in J Limited, and the value is going to be 6 lakhs, and the calculation is 60 lakhs into 10 percentage. And the moment the stake is sold, we understand that it is now available in cash. So right now, if you after this sale of the stake, if you visualize the balance sheet, the only thing is the investment in J Limited will no longer be there, but you will still have an asset of 6 lakhs, but that's going to be called as cash. So that's going to be the only difference, but still the liability side is not going to change. It's still going to be equity. So now for the if you look at the personal balance sheet of investor, cash of 6 lakhs on the asset side and equity of 6 lakhs on the liability side. Now let's go to step number 2, investment of rupees 6 lakhs in U Limited. Sorry, in this is not U Limited, this is Y Limited. Well, so investment of rupees 6 lakhs in Y Limited. So this is something that we understand, right? So you sell stake in a company which is overvalued. Obviously, you'll have to invest that in a company which is undervalued. But the interesting thing is, we're not going to be investing 6 lakhs in the equity of Y Limited. We are going to break this investment and we are going to invest a part of 6 lakhs in the equity of Y Limited, and we are going to invest the balance in the debt of Y Limited. Y Limited is a levered company, so it has some shares in issue, and let's say the debt is debentures or bonds or whatever. It also has some bonds or debentures in issue. So when we invest 6 lakhs, as an investor, when I invest my 6 lakhs in Y Limited, I'm not going to invest the entire 6 lakhs in the equity of Y Limited. I'm going to invest partly in the equity and partly in debt. I'm first going to tell you how much investment I'm going to do in equity, how much investment I'm going to do in debt. But like in the previous, like I did in the previous case, I'm not going to spend time now to tell you why I'm splitting up my investment like this, and also what is the basis of splitting up my investment like this. I'm not going to tell you that right now, but once we complete the arbitrage and look at the summary and see what is that we have actually kind of achieved for ourselves if you're an investor here, then we will come back to step number 2 and see why it makes sense to do step number 2 the way we do it right now. But let's just focus on numbers for the time being. So I invest partly in the debt of Y Limited, I invest partly in the equity of Y Limited, because Y Limited is a levered firm, so you have the possibility of investing in debt also. Let's see how much. 54,545 is invested in the debt of Y Limited, and the balance, which is 5,45,455, this is invested in the equity of Y Limited. So In the debt of Y Limited, 54,545 is invested, and in the equity of Y Limited, 5,45,455 is invested. Now, let's go to step number 3 and try to understand what is going to be the total earnings from Y Limited. Okay. Now, since I have invested in the equity and in the debt of Y Limited, I'm going to get earnings from both of these things. So, earnings from equity, from equity investment. So, we see Y Limited has 7 lakhs of earnings for equity, the entire equity. This is for 50 lakhs of equity. So 7 lakhs for the entire equity, and every rupee of equity earns 7 lakhs by 50 lakhs. So this works out to 14 percentage. And you multiply this with what you have invested in equity, which is 5,45,455. So let's see what we get here. 545,455 into 14 percentage. It gives us 76,364. So let me see what I get from debt, interest on debt investment. So let's look at the debt interest rate. It is 10 percentage. So if I've invested in the debt of Y Limited, I'm going to get 10% on my investment. How much have I invested? 54,545. So on this, I'm going to get 54,545. On this, I'm going to get 10%, which is going to be 5,455. So let me round it off to one number higher here, 5,455. Now let me talk about the total earnings. So total earnings is just going to be both of these things put together, 76,364 plus 5,455. Let's see what I get here. 76,364 plus 5,455 gives me 81,819, 81,820 if you want to round it off. So this is the total earnings I get from my investments in Y Limited. Now, so what? Well, let's look at the comparison, which is step number 4. That will tell us if this arbitrage was any exciting for the investor. So let's have a comparison. J Limited and Y Limited. So total earnings and investment. Okay. Now in J Limited, we see that the earnings that J Limited has for all the for the entire equity is 7,50,000, and the value of equity is 60 lakhs. So 7,50,000 divided by 60 lakhs gives 12.5%, which is what is given as cost of equity here. So J Limited is offering a return of 12.5% of 12.5% on equity investment. Our investor had 10% stake in J Limited, which amounted to 6 lakhs. So on 6 lakhs, the investor would be getting 12.5% return had the investor remained with J Limited. So I can call this as I get this as 75,000. So the earnings in J Limited for the investor, had the investor continued with J Limited, would have been 75,000. And since J Limited is an unlevered firm, well, all the investment of the investor was only in the equity of J Limited. So there is no question of investing in the debt of J Limited. So the total earnings of the investor from J Limited would have been 75,000. Now here we have the total earnings in Y Limited as 81,819. Let's look at the investment. Here it is 6 lakhs, And here also it is 6 lakhs. It's important to understand that since we never borrowed anything, we just, 6 lakhs was our money here. We which was in, if I'm the investor, 6 lakhs was my money. I had it invested in J Limited. I sold it off. I got back my money. Now I'm just putting that money in Y Limited. Now how I choose to split that money is not going to matter here. Is it my money or not is what is going to matter here. So it's 6 lakhs is my money. It's not like the previous case where I used my money and also some borrowed money. Here I'm using only my money, so I can call this entire 6 lakhs as my investment. Only thing is I choose to invest a part of this in shares of Y Limited. I choose to invest a part of it in bonds of Y Limited. That's completely fine. But how much of my money is getting invested? It's 6 lakhs. So what I observe here is 6 lakhs is the investment in both cases, but obviously moving from J Limited to Y Limited is making the investor get a higher total earnings. So for the same investment, the investor is able to get a higher net earnings, higher total earnings. So this is how a secondary arbitrage is done. So what this would tell us is, as the investor, as all investors in J Limited start observing this, naturally every investor would want to move out of J Limited and invest in Y Limited. And if this were to continue to happen, then we can expect the value of with more sale of stake in J Limited, we could expect the value of J Limited to fall. And with more purchase of stake in Y Limited, we could expect the value of Y Limited to increase over a period of time, obviously. And then we could expect both these values to come to an equilibrium and be equal to each other. So obviously, all this will happen over a period of time. We don't know when, and we're also not bothered about that right now. But the fact remains that this arbitrage would eventually lead to that effect, and has also had some interesting outcomes for the investor which does this. Great. Now let's try to look into it a little more and understand why this has actually happened. The first thing I would like to tell you here is, as an investor, when I had my money invested in J Limited, I was getting a return only of 12.5%. So what actually happens is, what has happened here is, I have removed my money from J Limited, which was giving me 12.5%, and I have now put my money in Y Limited, which is giving me a return of 14%. And 7 lakhs by 50 lakhs is 14%. So the return on equity in J Limited was 12.5%. But the return on equity in Y Limited is 14%. So for every money that I pull out from J Limited and I invest in Y Limited, I'm able to get a return of 1.5% extra. So every investor is attracted by this, right? So for the same 1 rupee of my money in J Limited equity, which is going to get me 12.5, instead if I pull it out and put it in Y Limited equity, I'm going to get 14%, which would mean extra 1.5% for me. So that's what is going to give me, that's what is going to attract me to do this here. Now, the point is, why is that an investor is likely to get extra 1.5% if the investor moves from J to Y? Why is Y Limited able to offer that extra return to equity shareholders than what J Limited is able to offer? The answer is simple. Y Limited is taking more risk than J Limited. The reason is J Limited has not gone in for any debt finance at all. J Limited is an unlevered company. So an unlevered company has no financial risk. Since there is no financial risk, the return that J Limited is able to offer its equity investors is only so much. But to the contrary, Y Limited has some debt in it, in its capital structure. Higher the debt in the capital structure, we have obviously spent time on this when we discussed about leverages. When the debt amount is higher, the leverage is also, the financial leverage is also higher. When there is a higher financial leverage, there's obviously a higher financial risk. But if there is a higher financial risk, if we understand that, the possibility of a higher earnings is also there. So with higher financial risk, with debt in the capital structure, Y Limited is able to offer a higher return to its equity shareholders. So that's the reason, first of all, that Y Limited is, I mean, that's the reason why Y Limited is able to offer a higher return on equity investment than J Limited is able to offer. Now, if that's the case, the next question here is, I remove 6 lakhs of my money from a source which was giving me 12.5% return, and I know that for every rupee of money I remove from that source and invested in another source, I'm going to get 1.5% extra. Then why did I choose to invest only part of my 6 lakhs in the equity of Y Limited, which gives 14%? And why did I choose to invest the balance of um, 54,000, that whatever number, 54,545? Why did I choose to invest that balance in debt of Y Limited, which gives only 10%? So instead I could have just invested the entire money in equity of Y Limited, right? So if I done that, let's see what I would get. Instead of getting 14% on 5,45,455, I would have gotten 14% on 6 lakhs. So on 6 lakhs, I would have gotten 14%, which would have been 84,000. And obviously, since I wouldn't have invested in debt, no, nothing here. But still, 84,000 is much higher than 81,819. So it would have made sense for me to invest the entire 6 lakhs in the equity of Y Limited. Why did I choose to invest a portion of it in the debt of Y Limited? Well, the logic is this. We saw that there is nothing very interesting in achieving a higher return by assuming extra risk. Now what actually happens here is, if I remove my money from J Limited and invest my entire money in Y Limited's equity, from a situation of no risk, I am moving to a situation of some risk. Let me explain that to you. As long as I was in J Limited, I had no risk because the company, when I'm talking about risk, I'm talking about the financial risk. Risk because of the existence of debt. That's what I'm talking about here. Okay. So I'm not talking about the general business risk to which every fund provider is exposed to. I'm talking only about the risk faced by equity investors with respect to the existence of debt finance. Okay. I'm talking only about financial risk. Since J Limited had no debt, J Limited had no financial risk. Since J Limited had no financial risk, as an investor in the equity of J Limited, I also had no financial risk at all. I had to bother about no senior person. So I mean, if J Limited if J Limited gets some earnings, the only group which will be able to take it will be the equity shareholder group. So there's not going to be any senior group to the equity shareholders group. So as an equity investor in J Limited, I was having a nice time. I had no risk at all. But when I remove my investment of 6 lakhs in J Limited and put it entirely in the equity of Y Limited, now what happens is I will be exposed to financial risk because Y Limited is a levered company and Y Limited has debt finance. So which means as an equity investor in Y Limited, I should be very careful about Y Limited's debt, which is the senior people in Y Limited compared to the equity group. So now this would mean that I've assumed more risk from a situation where I had to bother about nobody else. Now if I should think about a senior category, then obviously I've assumed some risk. So only after satisfying their claims, the company is going to come and start thinking of satisfying my claims, right? So from a situation of no risk, I've definitely assumed some risk. Since I've moved from no risk to some risk, obviously I've assumed extra risk. That would mean that I'm eligible to get higher earnings. So that is probably nothing exciting, right? So I took risk, I got extra earnings. Now, because I've invested like this here, partly in the debt of Y Limited and partly in the equity of Y Limited, what actually happens is, though I moved from a no risk company, which is the unlevered company, and I have invested my money in levered company, I have done my investment in such a way that I have shielded myself against risk. Yes, investment in a levered company does have risk. But I have invested in such a way, I have broken up my 6 lakhs in such a way and invested partly in equity and partly in debt of Y Limited so that I am able to have a shield for myself. And as much as Y Limited has financial risk because of debt finance, I as an investor in Y Limited, I do not have any risk here. So I am maintaining the same position of no risk and still I am getting higher return. How am I maintaining the same position of no risk? We understand why as an investor I had no risk when I was in J Limited. But in Y Limited I'm supposed to have risk because it's a levered company. But still I am saying that I have made my investment in such a way that I've shielded myself from any financial risk. How is that possible? How is the breakup of this investment helping me from that angle? What is that we have to understand here as the shield against financial risk? I would like you to take a quick look at the debt equity ratio of Y Limited. So let me call Y Limited debt equity ratio as, let me note it down. I have 5 lakhs is to 50 lakhs. So basically what this means is 1 is to 10. So this is the debt equity ratio of Y Limited. What this means is if Y Limited raises 11 rupees of finance, 10 rupees would be raised from equity, in the form of equity, and 1 rupee would be raised in the form of debt. So for every 11 rupees that Y Limited raises, 10 would come in the form of equity and 1 would come in the form of debt. So this is the debt equity ratio. Now, this would mean, let's assume like this, okay? When shareholders, for every shareholder who contributes 10 rupees to the company, who invests 10 rupees in the company goes ahead and raises 1 rupee of finance in the form of debt. So assume it happens this way. Y Limited first raises 10 rupees from a shareholder. As soon as it raises 10 rupees from a shareholder, it immediately goes outside and borrows 1 rupee in the form of debt. Then again it raises 10 rupees from another shareholder. Then it goes and raises 1 rupee in the form of debt. So for every 11 rupees it raises, let's assume it first goes and raises 10 rupees from a shareholder and then raises 1 rupee in the form of debt. Now, let's say, and let's also further assume that equity money is raised in multiples of 10. So first time it raises money, it would raise 10 rupees. Second time, another 10 rupees, so on and so forth. So equity money is raised in multiples of 10. Now, for every equity shareholder who invests 10 rupees in the equity of Y Limited, the shareholder would feel scared about the person who has given 1 rupee of debt finance to Y Limited. Let me repeat that. For every shareholder who invests 10 rupees in the equity of Y Limited is likely to feel scared of the person who has given 1 rupee of debt finance to Y Limited, because this person will be senior compared to the equity investor. So only after this person is paid off, the company will start thinking about paying any dividends or whatever to the equity investor. So every contributor, let me put it this way, every contributor of 10 rupees will feel scared of a contributor of 1 rupee, because this contributor of 10 rupees will be an equity contributor, this contributor of 1 rupee will be a debt contributor. So every contributor of 10 rupees will feel scared of one contributor of 1 rupee. So that's the fear of equity shareholders. Now when I invest my money in Y Limited, I don't need to feel scared, because for every 10 rupees that the company raises in the form of equity, it will raise 1 rupee in the form of debt. So when I have invested 5,45,455 in the equity, against this, the borrowed finance in Y Limited would be 54,545. So for my investment of 5,45,455 in the equity of Y Limited, the money that Y Limited would have obtained in the form of debt finance will be 54,545, because for every 10 rupees of equity money it takes, 1 rupee of debt money it will have. So for 5,45,000 of 455, it has in the form of equity because of my investment. It also has a debt finance of 54,545. Now, as a contributor of 5,45,455, should I feel scared of the person who has given 54,545 to the company. That's the main question here. As we said, every contributor of 10 rupees will feel scared about the contributor of 1 rupee debt finance. So applying the same logic here, my question is, as a contributor of 5,45,455, should I feel scared about the person who has contributed 54,545? Now, if I did feel scared, it'll be absolutely funny because the person who has given this 5,54,545 is also me. Because I have invested finance in the form of equity, I have also invested in the debt of Y Limited. So, for 5,45,455 of money that the company has taken from me in the form of equity, it has also taken 54,545 from me in the form of debt. So, I can't feel scared of my own self. So, I mean, if I say that there is a senior person to me, then the senior person is myself. So, I can't be obviously senior to myself. So, there is no need I'll have to feel scared because the senior claim here is that of me, is that of mine. So that's the reason I am able to avoid the financial risk even when I invest my finance in a levered company. So if I don't do this and I put my entire money of 6 lakhs in the form of equity, then that corresponding debt finance would not be from me, it would be from somebody else. Then I will be having the risk very live in front of me. But now I don't have the risk at all. So that's the logic behind the secondary arbitrage here. So this is how the secondary arbitrage has to be understood. Again, the steps are simple. Step number 1, sale of stake in J Limited. And then we have step number 2, which is basically investment in debt and equity. And then we have step number 3, total earnings calculation. Step number 4 is comparison. The logic behind splitting this is the debt equity ratio. So you should capture the debt equity ratio of the levered company. Here it is 1:10. In the same ratio you should invest. So here you should assume that the company is raising 11 rupees from you. 10 rupees it would raise in the form of equity and 1 rupee it would raise in the form of debt. You have 6 lakh rupees to be given to the company. Break the 6 lakhs into 11 parts. 10 parts of the 6 lakhs you will give it in the form of equity and 1 part you will give it in the form of debt. So that's the way you get the 1:10 ratio. So this is how a secondary arbitrage is done. So we have understood how a primary arbitrage is to be done. We have understood how a secondary arbitrage is to be done. So putting both of these things together, be it levered firm higher in value compared to unlevered firm or unlevered firm higher in value compared to levered firm, we can definitely perform this exercise of arbitrage, which would mean we will be able to achieve higher earnings with the same investment, with the same risk. At the same time, eventually we can also think of the firms merging with respect to their value. So that's how the arbitrage questions have to be tackled. Now, once you have understood question number 4 in its entirety, along with all the finer points, nitty-gritties, especially in step number 2 here, then I would suggest that you look at problem number 5, which is which is something that I would want you to try. As I said earlier in the previous lecture, problem number 5 is a study material question, which is to be exactly approached in the same way you understood question number 4. So step number 1, sale of stake, then step number 2, investment, and then step number 3, calculation of total earnings, and then step number 4, comparison. So that's the numbers are different. That's the only thing, but other than that, it's going to be absolutely the same way in which you will proceed. Only thing is in problem number 3 and in problem number 5, the value of the firm is not directly given. That's something you will have to obviously calculate. So you have the EBIT, and you have the earnings details. So from that you can calculate the EBT, and then you know EBT is equivalent to TAES. So calculate the value of the firm, and for both cases, value of equity, and then add value of debt for the levered firm, you will get the value of the firm. So it's as simple as that, right? So this is for both problem number 3 and problem number 5. Calculate the value of equity first, and then add the value of debt if at all it's a levered firm, and then you will get the value of the firm and see if there is any difference in the value of the firm, and you will be able to proceed with your arbitrage. So that's about the arbitrage questions. So now what we will do is we will wind up Modigliani-Miller method with a problem number 6. So here what we are actually going to be doing is question number 6. Um, we are going to be looking at theory with tax. So let's look at what we can expect to be the outcome. And after that, let's look at how problem number 6 has to be solved. Now, problem number 6 is a very famous question as far as the exam and the RTP appearance is concerned. It has appeared in the May 2012 exam for 5 marks. It has appeared in the November 2018 RTP and also in the RTP of May 2016. So as far as Modigliani Miller questions are concerned, and again, as far as I've observed the past exam question papers, the past many papers, I've not seen arbitrage questions come, but I've seen this question come several number of times. So from exam perspective, it is something that is important for you to note. Now, what is that would say if tax was brought inside picture? When tax was not there, value of the firm with different capital structures would still be the same if they were identical in all other aspects. But here, when tax is brought inside, we are going to say here that we are going to categorically say that value of a levered firm is going to be greater than value of an unlevered firm. This is definitely going to be the case. The reason is, if two firms are otherwise identical, I mean, in every other aspect, in terms of their business, in terms of their manufacturing, operations, risk, everything else, they are completely identical. But one firm has debt in the capital structure and the other firm does not have debt in the capital structure. We can assume that the firm having debt in the capital structure will be eligible for tax savings on debt. So tax is going to make cost of debt lesser. Tax savings on debt is some debt cost. Tax savings on debt cost is something that's going to make the overall cost of the company lesser, and if the overall cost of the company is lesser, we can expect the value of the company also to be higher. Now, we understood this in the cost of capital lecture, where we saw that whenever tax is brought inside the discussion, the after-tax cost of debt is going to be lesser than the before-tax cost of debt. Why is this the case? If the company debits interest against the taxable income is expected to reduce. As a result, tax is expected to reduce. So that this is what we call as tax savings. So after-tax cost of debt will be lesser than the before-tax cost of debt. And if after-tax cost of debt is lesser, then calculating the weighted average cost of capital using after-tax cost of debt compared to using before-tax cost of debt, obviously the WACC has to be lesser if you use after-tax cost of debt. That would mean the value of the firm will increase. Let's take the fourth principle here. Let's quickly look at that. Value of the firm was EBIT divided by WACC, right? Now, two firms which are exactly identical, same business, similar operations, same risk class, everything, we can expect them to have the same EBIT also. Or let's say we in fact find two firms with the same EBIT. Now, only difference is one firm has debt, one firm does not have debt. Now, obviously, if debt is there in the capital structure and debt is also something that will attract tax savings, we can expect the overall cost to be lesser. So, for two firms, let's say this is firm A, and let's say there's firm B, and firm A does not have debt, firm B has debt in the capital structure, and you're using this formula to calculate the value of firm for both of the companies, both of the firms. Let's say firm B is a levered firm. Obviously, if they have the same EBIT, the numerators will remain the same, but the firm which has debt is expected to have a lesser overall cost, so the WACC is expected to be lesser. If the WACC is expected to be lesser, then the numerators being the same, you can expect the value of the firm to be higher in the case of firm B than in the case of firm A. So we expect that the levered firm will always be having a higher value than the unlevered firm if you introduce tax into the discussion. So that's important. That's going to be the this is very important. This is going to be the proposition of theory with tax, right? So what does this actually mean? This basically means that we are going to classify this as a relevance theory. Capital structure relevance theory. This would basically mean that MM is saying that, you know what, if you had a structure which had no debt, then it's high time that you look at a structure, capital structure, which has debt. I mean, what does he indirectly say then? What do they indirectly say then? Capital structure is relevant for the value of the firm, right? So, theory without tax was classified as irrelevance theory. Theory with tax is classified as relevance theory. Now, let's look at problem number 6. Let's look at how the requirements of the question have to be answered. Kavesh Limited is an all equity finance company with a market value of rupees 25 lakhs and cost of equity of 21%. The company wants to buy back equity shares of rupees 5 lakhs by issuing perpetual debt at the rate of 15%. Rate of tax may be taken as 30%. After capital structuring and applying model with taxes, you are required to compute 1. Market value of Kavesh Limited, 2. Cost of equity, and 3. Weighted average cost of capital using the market value weights. Anyway, let's go one by one. Let's first address the first requirement, which is market value of equity. Let's first try to understand what is that we need to capture here for answering this part of the question. Earlier, Kavesh Limited was an all equity finance company. It had a total value of 25 lakhs. So when the company was all equity finance, the value of the company is going to be the value of equity, because we know that value of the firm is value of equity plus value of debt. But if it's an all equity firm, we don't have debt at all. That means value of the firm has to be equivalent to the value of equity. So Kavesh Limited, which is an all equity finance company, has a market value of 25 lakhs. That also means that Kavesh Limited has a value of equity of 25 lakhs. And they say that Kavesh Limited had a cost of equity of 21%. Now, let's look at what WACC is. WACC is basically proportion of debt into cost of debt plus proportion of equity into cost of equity. Now, in a case where there is no debt, there's no question of proportion of debt, that becomes 0. That means this entire thing goes away. So what actually remains is proportion of equity into cost of equity. All equity company proportion is going to be 1, or it's going to be 100%, into cost of equity 21%. So what essentially this means is, in an all equity company, the cost of equity is the same as the WACC. In an all equity company, the value of the firm is the same as value of equity, because there is no debt. So there is no question of any cost of debt affecting the weighted average cost of capital. So at this stage, by just reading the first line of the question, what we understand is before any capital structuring is done, the question talks about some capital restructuring. Before anything is done, the value of the firm is 25 lakhs, value of equity is also 25 lakhs, the cost of equity is 21%, and the WACC is also 21%. Now they say the company wants to buy back equity shares of rupees 5 lakhs by issuing perpetual debt at the rate of 15%. So basically now what they're saying is they want to change the capital structure, and 25 lakhs of equity, they want to buy back 5 lakhs of shares. And to buy back 5 lakhs of shares, they obviously need 5 lakhs of money that Kavesh Limited wishes to raise by issuing debt. So now they plan to introduce debt in the capital structure. So now 25 lakhs of equity finance, which also made up the value of the firm earlier, is now going to be replaced with some amount of debt, because equity is going to be bought back, and for that debt is raised, and debt is raised at the rate of 15%. Tax rate of 30% is given. They're asking us what is the market value of Kavesh Limited. Now, if there was no tax, if the tax rate of 30, if the line that says rate of tax may be taken as 30%, if that was not there, then we would say even after the restructuring, market value of Kavesh Limited has to be 25 lakhs. The reason is, if there is no tax, then theory would believe that value of a levered firm will be the same as value of an unlevered firm, because everything else remains to be the same. Same company, to be honest, it just changes its capital structure. Obviously, theory would say that the value of firm will not change. if there was no tax. However, when tax is there, obviously the value of the levered firm is going to be higher than the value of the unlevered firm. So here, what would be the value of Kavesh Limited after debt is brought inside the capital structure? We are going to look at a simple formula here, which we will use now and also at a later point in time. I'll give you the formula and quickly explain the logic also. Value of the levered firm is equivalent to value of the unlevered firm plus debt into tax rate. So this is a very important formula here. Value of a levered firm is value of the unlevered firm plus debt into tax rate. Now let's first apply that here. Let's fit in numbers inside this formula. Let's get the answer, and then let's understand what this formula is all about. So when Kavesh Limited was an all equity company, it had a value of 25 lakhs. Now the debt it wishes to raise is 5 lakhs and the tax rate is 30%. So this means the value is going to be 26 lakhs 50,000, because this is a 1 lakh 50,000 added to 25 lakhs. You will get 26 lakhs and 50,000. So 25 lakhs plus 1 lakh 50,000, you get 26 lakhs and 50,000. So the value of the levered firm, or the market value of equity, the market value of, no, this is not market value of equity, I'm sorry, my bad. This is market value of Kavesh Limited. After the restructuring is 26 lakh 50,000. So we see that the value of the levered firm is higher than the value of the unlevered firm. Now, the question is, how is the formula going to make sense? Why is value of a levered firm expressed as the sum of value of the unlevered firm and debt into tax rate? Why is that done? See, the first thing is, since we say that the value of the levered firm has to be greater than the value of the unlevered firm when tax is there, we definitely understand that the value of levered firm is going to have a minimum value which is equivalent to the value of unlevered firm. So that is why we have VU here, and more specifically we have a plus. So minimum this value plus it's going to be something else. Now, what is that extra thing? What is that thing that's going to that's going to increase the value of an unlevered firm when taxes? What is that that's going to increase the value for a levered firm when taxes brought inside discussion? The only thing is the tax savings on debt. So an unlevered firm will have the same value as a levered firm when there is no tax. If tax rate was 0, it will become 0 here. There's no scope for discussion. So it's only the tax savings that's going to increase the value. So the tax savings is calculated as debt into tax rate. Now, why is tax savings calculated as debt into tax rate? First of all, we should understand that here they say it is perpetual debt. That means it is irredeemable debt. If it is irredeemable debt, we understand that the value of debt, irredeemable debt, we understand value of debt itself is the present value of all the future interest payments. So value of debt is the present value of all the future interest payments. So what we can understand from this is, if I want to talk about, if I want to, let's say I am right, this is a timeline here, this is a timeline here, right now this is we are at T0. If I want to bring tax savings, if I want to bring T1 tax savings to present value, then I will take T1 tax savings discounted by 1 year. If there is going to be tax savings at T2, I want to bring T1 and T2 tax savings to present value. I will discount this. I will also discount this, and I will add both of these things. If I want to bring even T3 tax savings to present value, I will discount all of these things to T0 and I will add it up. But now I'm talking about perpetual debt. That means I want to bring infinite tax savings to present value. And every year my tax savings is going to be interest into tax rate. We understand every year tax rate is tax savings is going to be expense into tax rate. Here expense is interest into tax rate. So every year I'm going to take the interest amount T1. I'm going to take, let's say I1. I'm going to multiply it with tax. This will be the tax savings of first year. I will bring it to present value. Then I'm going to take I2 and then I'm going to bring it to present value. I'm going to take I3 and then I'm going to multiply with tax rate. This will give me tax savings, bring it to present value. But since we understand interest amount cannot change from year to year, I1 is equivalent to I2 is equivalent to I3. So let me remove all these numbers here. So every year I'm going to do a calculation I into T that will give me the tax savings. I'll bring it to present value. Rather, what I can do is I can first bring all these i's to present value, get the total present value of all the perpetual interest, and then apply and then multiply the tax rate with it once. Instead of multiplying tax rate with every year's interest, getting tax savings every year, and bringing it to present value, let me first bring all the interest amounts to present value. Then on the total present value of all the future interest payments, let me apply the tax rate. I'll get the total tax savings. So it's going to give me the same result. And how many future interest amounts should I bring to present value? Perpetual, it's a perpetual debt. So infinite amounts I should bring to present value. So all the future interest brought to present value will give me the present value of the entire interest, all the interest amounts on which I should calculate tax savings. And we understand that the value of debt is nothing but present value of all the future interest. So instead of saying present value of all the future interest amounts into tax rate, we are just saying debt into tax rate. So that's the logic behind why this formula is constructed the way it is. So from an exam perspective, if you understand this logic, great. If you do not, also it's still fine. You just need to commit this formula to memory and you will be good to use this and answer an exam question. All right. So now let's look at step number 2, which is the second requirement of the question. They're asking us to calculate the cost of equity. So KE. Now let's see how this has to be calculated. See, what we understand right now is value of equity is equivalent to earnings after tax divided by cost of equity. We have already seen this. Now we have seen this like this. In the basic principles, there's an EBIT minus I EBT. In cases where there is tax, obviously logically we would subtract tax also. So since we didn't have any tax, EBIT minus I itself EBT itself we discounted. So now since there is going to be tax, let's be very specific. EBIT minus I gives us EBT, minus tax gives us EAT. So infinite earnings after, and there is no preference share, so we can just take EAT as such. Infinite earnings after tax discounted at the cost of equity rate will give me the value of equity. So when Kavesh Limited was all equity, let me put that here clearly. When Kavesh Limited was all equity, the value of equity was 25 lakhs, and let's say I don't know what is the earnings after tax, let me call it as EAT, but I know the cost of equity was 21%, so let me discount it at 21%. So this would give me EAT is, if I cross multiply, this will tell me EAT is 25 lakhs into 21%. So I know my earnings after tax is rupees 5,25,000. Now, just a small thing to clarify. I want to clarify this once again. Now, I already have cost of equity. Then what are they asking me for? They're asking me for the revised cost of equity after the capital restructuring. So this 21% was before the capital restructuring. So now I have EAT of rupees 5,25,000 that Kavesh would have had, right? Now, I want to calculate earnings before tax. So there would have been some earnings before tax. Let me say there would have been some earnings before tax. From this 30% tax would have been subtracted. Then I would have obtained earnings after tax. So this earnings after tax is this 5,25,000. This would have been 70% of EBT. So which means EBT is going to be 5,25,000 divided by 0.7. So let's see what is this EBT here. So I get 7,50,000. So my EBT is 7,50,000. Now, before, when Kavesh Limited was all equity, EBIT and EBT would have been the same because there would have been no interest payment. So when Kavesh Limited was all equity, EBIT would have also been 7,50,000. EBIT would have also been the same number. So this is an inference that I have. So what I've essentially done right now is I've calculated what is the EBIT that Kavesh Limited would have had before the capital restructuring from whatever is available. Now let's see what will happen after restructuring, after the capital restructuring and debt is brought inside the capital structure. Will my EBIT change? No. Only numbers after that are expected to change. My EBIT is not expected to change. This is something that we have discussed in EBIT to EPS analysis itself elaborately. So when we talk about two different plans with respect to raising of finance, every number after the EBIT is expected to change, but EBIT is not expected to change because of different capital structures. So we have the same EBIT, but now we are going to have interest. And our interest amount is going to be 75,000. The reason I say 75,000 is my calculation goes like this. 5 lakhs is the debt amount I've raised into 15%, so it is 75,000. So this gives me my earnings before tax of 6 lakh 75. Now from this, let me subtract tax of at 30%. So I have 2 lakh 2,500. So now I have earnings after tax. Let me see what that is. 6 lakh 75,000 minus 202,500 gives me rupees 4 lakh 72 and 500. All right. Now let's apply the logic here. Value of equity is equivalent to earnings after tax divided by KE, which would mean KE is equivalent to earnings after tax divided by value of equity. Now I know my earnings after tax is 4,72,500. If I know my value of equity, I'll be able to find out cost of equity. Do I know my value of equity? I do know, because we know the value of the firm is 26,50,000. This is the value of the firm after restructuring. And we definitely know debt has a value of 5 lakhs. This is debt. This is also something we know. Then this would obviously mean that the balance 21 lakh 50,000 obviously has to come from equity. So I can put 21 lakh 50,000 here. So that would tell me what my it is going to be 21.97 percentage. So my cost of equity is 21.97 percentage. This was the second requirement of the question. But important observation is my cost of equity has increased from 21% to 21.97%. Why did the cost of equity increase? Mainly because we understand that all along Kavesh Limited was an all equity company, so shareholders had no financial risk, so they probably felt happy with 21% return. But the moment it becomes a levered firm with some amount of debt, now the shareholders are exposed to some amount of financial risk and they want a higher return for the higher risk that they are taking. So they probably do not settle down at 21%. They want 21.97%. So we can expect the cost of equity to increase with more debt in the capital structure. At least as far as Modigliani Miller theory is concerned, you can expect this as a definite outcome when debt is introduced into the capital structure. The last part of this question is the calculation of weighted average cost of capital. Now we know weighted average cost of capital calculation is proportion of debt into cost of debt plus proportion of equity into cost of equity. So let's do that. Debt we know is the value is 5 lakhs. So 5 lakhs divided by 26 lakhs 50,000 gives us the proportion of debt. Now when you calculate cost of debt, we should be careful. 15%, now here we can understand this. The 15% is given as the rate at which perpetual debt is raised. That is the before tax cost of debt. After tax cost of debt should be calculated like this. KD is interest into 1 minus tax divided by value of debt. It is like saying C into 1 minus T by price. Okay, it's like that. My interest is 75,000, I know, and my 1 minus tax rate is 0.7, and my value of debt is 5 lakhs. So this should tell me what my cost of debt is. 75,000 into 0.7 divided by gives me 10.5 percentage. This 10.5 percentage I could have also calculated as 15 percentage into 1 minus 0.3, which is basically 15 percentage into 0.7. So this will also give me 10.5, but it's important to understand when there is tax, the after tax cost of debt must be calculated properly. So 0.105, or we can probably say 10.5 percentage itself, plus proportion of equity is going to be 21 lakh 50,000 divided by 26 lakhs 50,000 into cost of equity is, now we know, 21.97 percentage. Let's calculate that. Let's look at the proportion of debt. 5 lakhs divided by 26 lakh 50,000, 5 lakhs divided by 26 lakh 50,000 gives us 0.1887. This is the proportion, 18.87 into 10.5 percentage. And proportion of equity, let's just do a simple thing. 1 minus 0.1887 should give us 0.8113 into 21.97 percentage. Let's see what this gives us. 0.1887 into 10.5 gives us 1.98 percentage plus 21.97 into 0.8113. 21.97 into 0.8113 gives us 17.82 percentage. Now 17.82 percentage plus 1.9, 17.82 plus 1.98 gives us 19.8 percentage. Let me check that once again. 17.82 plus 1.98 gives 19.8 percentage. So my weighted average cost of capital or overall cost is 19.8%. So here again an important observation is worth making. Before the restructuring, when Kavesh Limited was an all equity company, the overall cost was 21%, right? The cost of equity was also the cost of overall cost. This is an observation that we had before we started calculating the market value. So now we see here that the overall cost has dropped to 19.8. And this is in line with what we expected would happen here. We said the levered firm's WACC will be lesser than the unlevered firm's WACC. Our Kavesh Limited was unlevered all along and had a WACC of 21%. Now, when Kavesh Limited became a levered firm, we expected WACC to drop. It did drop to 19.8% because a cheap source of finance is coming inside a cheaper source of finance is coming into the capital structure, and the cheaper source is cheaper not only because it is not only because debt is in general cheaper to equity. Tax savings is also contributing, right? 21.97% cost of equity. Before tax cost of debt is 15%, which itself is lesser than the cost of equity, but 10.5 is even lesser because we are talking here about after tax cost. So we expected the WACC to drop. It did drop. You get 19.8%, right? So now what actually happens is this. Same EBIT, okay? Same EBIT, but we can see the WACC is reducing, which would mean the value of the firm obviously has to definitely increase, right? So that's very important for us to understand. So this answers the requirement of question number 6. As I said, it's an important problem as far as the exam is concerned. So this also concludes our discussion in Modigliani-Miller theory. So Modigliani-Miller theory itself, we understand one theory without tax was an irrelevance theory, and one theory with tax is going to be a relevance theory. So now what we will do is we'll have to look further. There are a couple of more concepts for us to look into. actually, we have, to be specific, we have three concepts. We have one more than a couple concepts. We have a concept called the traditional theory, and then we have a concept called the net income theory, and then we have another thing called the net operating income theory. So to be precise, there are three concepts we need to look at in this topic area. So however, let me wind up this lecture with this. So this was the second lecture in capital structure, which focused purely on Modigliani and Miller theory. In the next lecture, we will look at the balance in this topic area, and the next lecture, the third lecture, will be the last lecture in in capital structure.